We recognize the aesthetic of the Stratton Oakmont era, the marching bands, the helicopters, and the yachts fueled by an ocean of cash. The parties became pop culture landmarks, but the mechanical engine that funded them remains largely misunderstood. Director Martin Scorsese focused his lens on the high-octane rise and fall of a criminal figure, leaving the specific accounting of the fraud on the cutting room floor. Belfort himself admitted to omitting certain details from his own book to avoid further legal exposure regarding the proceeds of his crimes. Jordan Belfort built his empire by identifying a structural exploit in the stock market's plumbing. By moving capital through unregulated channels, he bypassed the transparency requirements that typically protect investors from predatory brokers. The capital for this lifestyle came from the life savings of public school teachers, military veterans, and retirees who trusted a confident voice on the phone. To understand how those savings were extracted, we have to look past the entertainment and break down the Stratton Oakmont engine step by step. The entire machine runs on a basic reality of the brokerage business. A stockbroker earns a commission every time they process a trade, regardless of whether the client's portfolio gains value or collapses. On a major exchange like the New York Stock Exchange, commissions were typically capped at around 1%. However, Belfort operated in the over-the-counter market, or OTC. In an OTC market, trades happen directly between two parties, without a central exchange auditing the companies or refereeing the price. This chart shows the incentive structure that built the firm. A $10,000 trade in a legitimate company earned a broker $100. But for an unregulated OTC penny stock, that commission bar on the right swells to $5,000 for the exact same phone call. As the 50% commission bar multiplies, the payout turned every trainee into a relentless salesperson for a worthless asset. This commission structure ensured that targeting unsophisticated investors was the most profitable decision a broker could make. The fraud began with the setup. As illustrated in this flowchart, the firm identified a shell company, a business with no real operations, and distributes funds to a network of secret partners called rat holes. These partners quietly bought massive blocks of the stock for pennies. Stage 2 was the pump. Hundreds of brokers launched a coordinated psychological campaign, using high-pressure scripts to convince retail investors that this worthless company was a rare opportunity about to be discovered by Wall Street. This line chart shows the result of that psychological pressure. An artificial flood of buy orders from retail investors drives the price upward, creating a feedback loop of manufactured excitement. While the rising price looked like evidence of a successful company, it was actually the visible record of a coordinated manipulation. Stage 3 was the dump. Once the stock hit a target peak, the architect signaled the rat holes. This flowchart shows the reversal. The insiders sold their millions of shares simultaneously, which drains the capital from the company and moves it directly into the architect's accounts. Stage 4 was the trap. While the insiders exited, the firm's brokers were ordered to ignore their phones. By refusing to answer or intentionally losing paperwork, the firm physically prevented the public from selling their shares while the price was still high. Watch the line chart as the insider capital disappears. With no genuine market demand, the entire structure crashes to zero. The retail investors were left holding worthless paper, while the liquid cash had already been transferred to the inner circle. The firm eventually applied this mechanic to initial public offerings, the first time a company sells its shares to the public. By taking recognizable brands like Steve Madden public, Belfort exploited the trust people placed in regulated exchanges to hide the same underlying scam. The machine functioned as a zero-sum transfer. Every dollar of profit pulled in by the inner circle required a working-class investor to lose their entire position. Federal agents eventually raided the Stratton Oakmont offices, seizing the records and wire transfers that led to charges of money laundering and securities fraud. Despite the scale of the crime, the legal consequences were brief. Belfort served 22 months in a minimum security facility with tennis courts, where he met comedian Tommy Chong. It was during this time that he began drafting the memoir that would lead to his global fame. Of the $110 million in court-ordered restitution, only a small fraction has reached the victims. Belfort continues to earn millions through speaking engagements and media rights, essentially capitalizing on his history of fraud. The mechanics of the Stratton Oakmont era have been entirely digitized and fully automated for the modern market. This split-screen comparison shows the direct evolution of the scam. The unregulated penny stocks of the 90s are now meme coins. The brokers and boiler rooms are now YouTube influencers and Discord community leaders. Today's rat holes are anonymous crypto whales, and the cold calls have been replaced by Telegram pings. This system allows the same formula to extract capital from investors instantly across international borders. The mechanics of the pump and dump remain active in today's markets. When a voice on a screen promises a 10x return on a hidden gem, the viewer is looking at a machine designed to extract capital.